You know that great feeling when you check your portfolio and see a positive return? It's awesome, but it's not the whole story. The number you see on the screen isn't what actually ends up in your pocket. And that's because you've got two silent partners on your financial journey: charges and taxes. So let's dive in and figure out how you can keep more of what you earn.
This is really the most important question for any investor, isn't it? That exciting, say 10% annual return can shrink surprisingly fast once everyone else has taken their slice of the pie. So in this explainer, we're going to pull back the curtain and see exactly who gets a piece of your profits and, just as importantly, why.
All right, first up, let's talk about wealth management charges. These are basically the fees you pay for all the expertise and the infrastructure that's busy managing your money. Now, they aren't hidden, but you definitely need to know what you're looking for. Think of them as the cost of doing business in the investment world.
Now, what's really key to understand is that these charges can pop up at pretty much every stage of your investment's life. You might pay an initial charge, kind of like an entry fee, just to get into a fund. Then, while you're invested, you've got ongoing charges for the day-to-day management and admin. Some funds even have performance fees, where they take an extra slice if they do exceptionally well. And then, of course, you might face exit charges when it's time to sell.
So, how are these fees actually calculated? Well, it really depends on the service. If you're getting some specific financial advice, that might just be a one-off fee. But for your ongoing portfolio management, the most common model you'll see is an annual management charge. It's usually a small percentage of your total assets that gets charged bit by bit, maybe quarterly.
So here's the good news. You have the right to know exactly what you're paying for. This isn't just a suggestion, it's a regulatory requirement in most places. Before you sign on the dotted line, a firm has to give you a clear, written breakdown of all the potential costs. This is so important because it empowers you to compare different services and make sure you're actually getting good value for your money.
Okay, so once you've gotten a handle on the fees, your second silent partner steps into the room: the tax authority. It doesn't matter where you are in the world, investment growth is almost always a taxable event. And understanding how this works is absolutely fundamental to smart financial planning.
Before we get into the nitty-gritty, let's just make this basic distinction super clear. You've got direct taxes, which are levied directly on you, on your income or your wealth, and these can be adjusted for your personal situation. On the other hand, you have indirect taxes, which are baked into transactions, like a sales tax. For our purposes as investors, we're almost always focused on those direct taxes. So the first and most common tax is, you guessed it, income tax. And this isn't just about your salary from work. As an investor, this applies to any income your assets happen to generate. That could be interest you earn from bonds, or, and this is a big one for many, the dividends you receive from stocks.
Next up is capital gains tax, or CGT for short. This one is so important to understand. It's the tax you pay on the profit you make when you sell something. So if you buy a share for 100 and you sell it later for 150, you don't pay tax on the full 150. You only pay tax on the $50 gain, and that's a huge distinction, right? The tax is on the profit, not on your original money.
And finally, we have estate tax. You might know it as inheritance tax. This is a tax on the total value of your assets when you pass away, and it's paid out before your beneficiaries get anything. For anyone who's building up significant wealth, planning ahead for this tax is absolutely key to making sure your legacy is passed on efficiently.
Okay, so that all makes sense for investments at home. But what happens when your portfolio crosses borders? Investing internationally opens up this incredible world of opportunity. But you guessed it, it also adds a whole new layer of tax complexity that you really need to get your head around.
So let me introduce you to something called withholding tax, or WHT. Say you own shares in a foreign company, and that company pays you a dividend. Well, that company's government will often withhold a piece of that dividend as tax before it even gets sent to you. It's a tax that gets deducted right there at the source.
And this, of course, raises a massive question. If the foreign government takes a slice through withholding tax, does your own government then turn around and tax that same dividend again? This is the dreaded trap of double taxation. And honestly, without a solution, it would make investing internationally a really bad deal.
Luckily, there is a solution. Governments realize this was a problem, and they create what are called double taxation agreements, or DTAs. These are basically treaties between two countries where they agree on a set of rules to stop income from being taxed twice. They'll typically set a much lower, preferential rate of withholding tax for residents of the other country.
So how do you actually get the benefit of one of these agreements? Well, there are two main paths. The best way is something called relief at source. If you get the right paperwork filed ahead of time, you're charged the correct, lower tax rate right from the very beginning. The other path is a repayment claim. This is more reactive. The full tax is taken out, and then you have to go through what can be a pretty complicated process to claim that overpayment back from the foreign tax office.
So, we've covered charges, we've covered domestic taxes, and now international taxes. What's the one key principle that really ties all of this together? It all comes down to this. For tax purposes, where you live is everything. And this really illustrates the two major ways countries handle this. Most countries, like the UK, Germany, or Japan, operate a worldwide system. If you're a resident there, you are taxed on your income from everywhere in the world. But other places, like Hong Kong, use a territorial system. There, you're only taxed on income that actually comes from within that country. Knowing which system your country of residence uses is the absolute foundation of any good investment and tax strategy.
So here's the ultimate thing to think about. It's not just about making money, it's about understanding the entire ecosystem your money lives in. When you know the charges you'll pay and the taxes you'll owe, you stop being a passive passenger and you become the pilot of your own financial future. Your money is working hard for you. But are you sure you know who else it's working for?